Welcome back. Research analyst at the financial derivatives company Nosike Nwajiri joins me now to discuss the latest burning economic issues at the domestic commodities market. Good morning, Nosike. Thanks for coming on the program.
Good morning. Thanks for having me.
Well, let's begin our conversation with oil prices. Of course, positive economic data from Europe, Asia, and the US have driven up prices, even though investors still remain concerned about the rising COVID-19 cases, of course, which could threaten supply, and as OPEC also begins to lift supply cuts. Tell us what other factors are driving the price movement at this time.
Basically, those are the major factors. It's important to know that at this time, OPEC is basically cutting back on output curbs that have been in place for several months. Basically, we want to go from 9.7 million to about 7.7 million, and this is coming at a time where there's a resurgence in coronavirus cases. So the market is a bit let's sit back and watch for a minute. Let's see how this plays out, because I mean, if the coronavirus cases keep increasing, especially in the advanced countries, the biggest consumers of oil like the US, Europe, even in China, there's been efforts by the governments to, through increased liquidity, increased government intervention, and not bailouts, but trying to measures to boost the economic recovery and cushion the negative effects of COVID-19. There's been increased liquidity, so the market is just laying back and saying, okay, there's a lot of money in the hands of people, especially in the US, and they could increase demand, so to speak. But then again, if there's a resurgence in coronavirus cases, there've been lockdowns new lockdowns in several cities in the US. That would weigh majorly on the demand for oil in the coming months, and you could see prices tank to where they were a couple of months ago, and we wouldn't want that. That would be less than $30 a barrel. Nigeria is more sensitive to cuts in production than to cuts in price. So at a time where we've seen prices increase to currently about 44, Nigeria's oil production has in compliance with OPEC plus agreed cuts. It's gone from about 1.59 at the end of May to 1.5 at the end of June, and should even fall further, even when other OPEC members are, rolling back the cuts. So, I mean, it's good for oil prices in general. The OPEC as a cartel have seen that, okay, at this point in time, we were not necessarily fighting for market share with the shale producers in the US, so we can roll back on these cuts and get back as much market share before oil prices rise to above $50 a barrel, where those shale producers are competitive, so to speak.
Perhaps once again, this reiterates the need for the Nigerian government to urgently reduce its reliance on oil revenue. Of course, we'll continue to see a steady decline in the external reserves.
Yes, the external reserves, obviously, oil proceeds are the number one contributor to why the external reserves have been on the decline. There's also the capital outflows at this time, where there's a lot of uncertainty as regards the naira. A lot of capital outflows. There's investors are there's a lot of liquidity. There's a global surge in liquidity at this time. Investors are looking for they are less risk averse at this time, but even at that, Nigerian stocks, because of the issues surrounding the naira, are a no-go area for many of them. There's also dwindling remittances. Until the global economy fully recovers, we won't see a rise in remittance inflows, which are basically our second largest source of foreign exchange at this time, after oil. So, I mean, if oil proceeds are not looking good at the moment, remittances are down, capital inflows have dwindled to levels not seen in quite some time, we expect the reserves to even fall further in the coming weeks. And obviously, there'll be the impact on the currency as well. We saw a rise in a marginal increase, a marginal strengthening of the naira yesterday, but that is only because the CBN has taken steps to through CRR debits, reduce the amount of liquidity in circulation. I mean, banks. You want banks to lend at this time. There's this LDR ratio that's in place to ensure that they lend, but there's this heightened credit risk at this time. But the CBN is doing. I mean, if you can't lend, it means that there's this money supply that just liquidity that's lying in the banks, really, and that means that there's more money to speculate with, and there could be increased forex demand. So the CBN is doing all they can to curtail that, and massive CRR debits at this time, and we've seen the Naira respond positively.
And are we likely to see the Naira stabilize at this current rate for some time?
That remains to be seen. If it's always, it has to do what's the outlook for oil, how the CRL debits. I mean, what's the outlook for liquidity? Are we as the FAC? And this is the start of the month. They will soon share another round of FAC allocation would flow into the system. We'll see, and with basically the second devaluation we've had. The first devaluation was sometime around March. This was the last one was in late June, early July. So we'll see an even higher FAC inflow this by the time the next FAC revenues come, and that will be increased liquidity, and might see increased speculation. And there's even pent-up demand, estimated about 5 billion naira. So the pressure at this time, there's a lot of volatility with the currency, and there's this backlog of demand. So I don't see Naira appreciating much in the coming weeks.
All right, Nosike, one other topical issue, of course, that you're aware of that has dominated headlines since yesterday is that Shoprite is contemplating its future in Nigeria. Of course, we've had several interpretations to the statement that was released yesterday by the group. But tell us, what's the true picture and the possible implications?
I think it remains uncertain. I mean, there was news in international media that even the parent company in South Africa, the share prices rose in response to news that it's planning to divest from its Nigerian operations. Obviously, that would mean that the market perceives the Nigerian operations as a major drag on the value of the stock or the performance, so to speak. But there's been South African businesses in the past that have left the Nigerian retail space. Recently, just a couple of months ago, it was Mr. Price. It was Woolworths, as I think 2013, and Truworths 2016 in the past. So we've seen this when there's a difficult business environment, you have to contend with forex rationing. I mean, as a retailer, you need to get your goods. You need to first of all get forex to buy your goods. You need to get your goods from the ports to your shelves, which is at this moment there's some major constraints about that. You need to be able to repatriate your profits. Over the period of the lockdown, there were issues surrounding supply chain disruptions. So there's a difficult operating environment. There's also the shrinking middle class. There's falling consumer demand, if you will. So all those factors come into play, and the outlook is not looking very good. So it's looking to sell off its Nigerian assets and leave while it can. So I mean, if given all the factors, considering all the factors, any investor, and we've had 2 devaluations in the past 4 months. So I mean, even if you get forex to repatriate your profits, you might be making a loss. Your profits might just automatically become a loss because of exchange rate devaluation. So when you consider all these factors, you can't really blame any investor who's been here for about 15 years. They have about 25 stores nationwide. I mean, everyone thought that you'd be looking to stay for much longer and grow their footprint in Africa's biggest market. They have about 2,000 stores across the continent. So it's, like I said, it remains to be seen. We're seeing claims and counterclaims and rumors and publications countering those rumors. So it remains to be seen. But all in all, as it stands, you can't really blame any investor given the current climate for seeking to cut his losses.
But what difference would it make even if a Nigerian investor buys into the business? Because some of these challenges that you mentioned are there anyway.
Okay, so the issues surrounding forex and repatriation of profits, that would no longer be an issue. There will probably be increased partnerships with Nigerian suppliers as opposed to overseas suppliers. So I mean that in itself saves a lot. Forex saves and it'd be nice to save the jobs. Given the current climate, you don't want more people joining the unemployment market. So it'd be nice to see Nigerian investors come and take up the mantle from where Shoprite leave it, and hopefully the issues surrounding consumer demand, it's a shrinking middle class, probably that will weigh on demand. So they might actually seek to reduce the size of their operations. All in all, we hope they maintain the jobs and all. But I mean, a Nigerian operator coming to take up from where Shoprite leaves, I think it's good in the medium to long term. It's good for the Nigerian economy as a whole.
All right, now let's talk about commodity prices. Now, where are we in terms of price movement, especially after the Eid festivities just passed?
Okay. Now, typically at this time of the year where there's Eid festivities, so typically during Easter or Christmas or any of these Muslim holidays, before that holidays, they build up the market. In the markets, the sellers, buy a lot of stock, hoping to sell, and there's increased prices around that time. But we didn't see that during this period. There was subdued demand. Basically, the issues surrounding consumer demand, shrinking middle class, incomes are falling, a lot of people out of work, so demand just wasn't there. So you had that last week. Now this week, those buyers who stocked up on inventory, there will be a post-Eid sell-off, so to speak. So going to sell off as much as they can, and we should see prices fall as a result. And also, there is typically at the harvest season. There's harvest season for yam, New Yam Festival, and cassava in the coming weeks. So that should also bring the expected prices to fall lower in the coming weeks.
And what about cocoa prices? They've risen up to $2,400 per metric ton at the international market.
That's driven by rising global demand. For Nigeria, Nigeria produced about 280,000 metric tons last year, earning about somewhere about $700 million. It's our top agri export. And right now there's issues surrounding excessive rainfall. There's a disease associated with excessive moisture in cocoa. When moisture levels rise to about 12 to 15%, as they currently are because of the excessive rainfall, there's this disease, there's a certain disease, the name escapes me now, and typically, optimal moisture levels are about 7.5%. Well, now we have moisture levels that are twice that amount. So that disease is lowering quality and good quantity of output. Output is down already about 10 to 12%. How do you overcome this? You overcome it by the use of fungicides, but these are largely expensive. And the cocoa farming is done by small farm holders, and these are guys who don't really have the funds to be going out to get fungicides. So we might see cocoa production fall by as much as 40% this year. So it's a major risk.
All right, just before you go, Nosike, tell us what you think about the latest PMI data released by FBN Quest, which of course shows a 2.04% decline in July.
I think it was expected. At this moment, consumer confidence is subdued. So people are not spending as much as they ordinarily would. I mean, the outlook for, if you're unemployed, what's the outlook for jobs? If your income has fallen, you would cut back on some of these purchases that you make regularly. So, I mean, it was expected. New orders are probably flat. All the sub indices were mostly flat, and the rest were on the downward trend. So it's something we expect to see in the coming months, probably get even worse, given the FX shortages, given that we have forex shortages at the moment, and the IEFX window, the CBN has not supplied that market for about 4 months. So FX shortages should begin to impact the manufacturers, and we'll probably see the FBN PMI fall even lower in August.
Research analyst at the FDC, Nosike Nwajide, thanks for coming on the program.
Always my pleasure.
Well, we'll be back in just a moment. Please stay with us.